It's a big week in markets. For the first time in several weeks, the US and China are going to engage, at least over the phone, in further trade talks. This after Xi Jinping and President Trump had something of a love-in at the G20, but it's quite likely that progress is going to be grindingly slow. It's quite clear that China has indeed hardened its stance since they came apparently relatively close to a deal at the end of last year. Of course, Trump, I think, also quite wanting to continue to up the ante. You're also starting to see earnings season in the US ramp up. You've got a little under 10% of the S&P 500 reporting this week. Will these companies report better than expected earnings? Well, do you know what? This is all stage managed. So the answer to that is probably yes. It does appear that the earnings estimates going forward into 2019 and beyond have shown some sort of stability over recent weeks. But I think one thing which is certainly more difficult to stage manage and which the market is probably going to be rather more focused on is the sort of guidance that these companies are going to be given for the rest of the year and again into next year. The market's had a very, very strong run. We reached record highs in US markets last week. There's a reasonable amount of growth still being priced into these equities. Let's see if we can get confirmation that those are going to deliver. But perhaps, however, the most important thing that's going to occur this week is Jerome Powell, the Fed chair, testifying before Congress on Wednesday and Thursday. Now, President Trump has launched a relentless attack on the Federal Reserve this year. It has, if anything, intensified over recent days, with Trump, among other things, tweeting that they have no clue. Whilst I might share actually some of his sentiment, these sort of open attacks against the Fed is making the market quite nervous. And if you look at where the market thinks rates are going to go, yes, they are incredibly dovish on rates. We've seen that reflected in US Treasuries in recent weeks, with yields collapsing across the curve. But we've also seen a lot of implied volatility in and around that. So again, a certain amount of uncertainty being generated, and of course the backdrop to this is basically political interference with the Fed, challenging Fed independence. So it's going to be interesting to see whether Jerome Powell pushes back to any great degree during his testimony to Congress this week. You've also got to bear in mind as well that we are starting to ramp up into electioneering territory. These sorts of events are almost certain to be quite prominent in terms of political grandstanding. There's probably going to be quite a sharp divide, I would imagine, between the people who are questioning him, whether they're Democrats or Republicans, and the sorts of questions they're going to be asking will give clues as to what their stance might be in terms of how they're reacting to the president's attack on the Fed. But I mean, more fundamentally, of course, the market will be looking for clues as to what the Fed's next move might be. Yes, we've had some more aggressive rate cut expectations pared back after last Friday's better than expected non-farm payrolls. However, Fed fund futures are still discounting about 100 basis points of loosening from the Fed over the next 18 months or so. So a very, very dovish outlook expected there. I suspect that Jerome Powell ultimately will take a line that the Fed is quite prepared to take a so-called precautionary cut in rates in order to underpin US growth, but is in no way likely to validate the very aggressive rate cuts that the market is still pricing in. Even so, it's definitely worth focusing on that testimony during the course of this week and look for some market movement in and around that.